Awesome. We are now live on our various social platforms. So thank you everyone for taking time to join us for today's session on how to leverage personal expenses as business deductions. Bit of a misleading description there. What we should be clear as legitimate business deductions that often get confused as personal expenses. We're going to do our best to go through and explain the difference between the two, between a personal deductible expense and a personal non-deductible expense. But first, a little bit about us. For those of you who are not familiar, my name is Andrew Wall. I'm the managing partner here at CPA4IT, and our mission is to help independent contractors organize their finances, create wealth, and transform wealth into a legacy. As many of you know, we put on seminars like these every 2 weeks. And we're excited to have this session today and talk to you through some of the most common deductions that most people are either not aware that they can claim or not maximizing those deductions to their full extent. So we'll start with an agenda here. We'll go through understanding your business deductions. Then we'll look specifically at some categories like the home office, the automobile, meals and entertainment, some other expenses, and then, of course, those non-deductible personal expenses that you will not be able to claim. Again, as a reminder, for those of you who are joining us on any of our social media channels, if you have any questions or comments, you can post those in the chat and we will do our best to relay those over to our live webinar here on Zoom. For those of you in our Zoom session, please use the Q&A and I'll do my best to answer those questions as I see them. And of course, if we do happen to miss anything, we'll post responses to the videos, which will be available instantly as soon as the session is completed. So without further ado, let's talk a little bit about what constitutes a business deduction. So first, the expense must be incurred to earn business income. It also must be reasonable in the circumstances, and it must be directly linked to business activities. Now, a lot of this is very subjective. And of course, you need to have the documentation with the receipts or other appropriate records. And one thing I do want to make sure is clear on this is, as accountants, we don't often ask you for the original source documents of the receipts in order to do your filing. But if you are ever audited, you do need to be able to provide the original receipt. And that is not a credit card statement or a bank statement. You need the original receipt because it has the line item detail as well as the tax account information for the supplier. There is one other criteria that we don't discuss here, and that's that the item must not be specifically disallowed by the Income Tax Act. And since a lot of these requirements are in the gray area, or what I would call as subjective, what we want to encourage you to do is to interpret your expenses as aggressively as you possibly can. Now, as a firm of accountants, we're certainly never going to allow you to claim anything that is specifically disallowed by the Income Tax Act or that is disallowed in general. But we want to coach you to maximize your deductions because every dollar that you're able to deduct as a business expense is a dollar that you won't pay any taxes on. That's no corporate taxes, no personal taxes. And if you're paying for those expenses with funds from outside the corporation, you'll even be owed a reimbursement for those expenses that you have paid for. So now that we understand what, generally speaking, is a business expense, what are we talking about when we're talking about these personal expenses? What we're referring to as lifestyle expenses. And deductible lifestyle expenses are expenses that you might have had prior to incorporating things like your internet or cell phone, that now that you have a business are legitimate deductible lifestyle expenses, assuming that you're using the internet for your business, which I'm certain you are, and you're using your cell phone for business. Now, there are other non-deductible lifestyle expenses, and these are things like children's diapers. Pretty hard to find a justifiable business reason for that. But there are situations where things that are even specifically disallowed by the Income Tax Act might be legitimately deductible for your business. And that's because it's dependent on the nature of your business. You can imagine that if you wanted to deduct dog food that you're buying for your pet, clearly not a deductible business. Now, if on the other hand, that you are a dog walker and your business is training and boarding dogs, then dog food might be a legitimate business expense. In fact, we have had some situations recently where we've been able to claim club memberships, which are one of the things that are specifically disallowed by the Income Tax Act because the individual was a fitness influencer, and there were some exceptions available that allow you to claim something that is actually specifically disallowed in the Income Tax Act, as long as they were shooting and providing content in the fitness club where they had a membership. So what we're trying to differentiate between here is the things that you can claim as business expenses that are reasonable, that have the ability to help your business earn income, and aren't specifically disallowed by the Income Tax Act. And that leaves a lot of things open to interpretation. Now, many of you know that on our website, we have a page called Expenses, where you can find our standard chart of accounts and the most common things that you can deduct as business expenses. But the most important thing I want to be clear on is that that is not an exhaustive list. That is meant to be an introduction to the types of things that you could deduct. But as long as we can come up with a business reason as to why we have used that for our business, and as long as it's not specifically disallowed by the Income Tax Act, we have a good probability of being able to deduct that business expense. And as I said earlier, that means that you won't pay any corporate tax on this business expense, and you won't pay any personal taxes on that business expense. Now, there are a couple of things that you probably are going to have a hard time justifying and being able to claim. As I mentioned earlier, those items that are specifically disallowed by the Income Tax Act, which include golf green fees, club memberships, your primary home telephone line, as far as a landline, secondary lines, those types of things are allowed. But we also have some other things that are more in the gray area. And those are things like personal entertainment and clothing and personal accessories, as well as personal grooming and haircuts. And I say that these are in a gray area because these are not specifically disallowed by the Income Tax Act. But the CRA has a pretty active stance that they are not going to allow any clothing that is not a uniform. So that means suits, ties, those types of things. But it's not specifically disallowed in the Income Tax Act. So what this basically means is if you are audited by CRA, they will likely disallow these expenses, and you will have to pay the taxes at that point if you had claimed these expenses. And the potential benefit is that you're never audited and you get those deductions. The downside is you might be paying the taxes plus some interest down the road if you are audited. Now, because these aren't specifically disallowed by the Income Tax Act and there is a business argument for it, we will allow clients to claim business clothing and even personal grooming to the extent that you're doing public presentations. But be aware that if CRA sees this, they will deny it and try and push you towards tax court. And the issue there is you would have the opportunity after CRA denies it and after you appeal it and you go through the 3 levels of appeals within CRA, which you would be denied on all 3 levels for things like personal clothing. At that point, you would have the option of going to tax court. The reality is that very few people are going to go to tax court for business clothing, even though I personally believe it's a very legitimate deduction. People who buy suits and only wear them for work should be able to claim those, but CRA is going to deny it because they're going to say it's not a uniform. And you could wear it out in public, and therefore it is personal. That is their interpretation. You have your interpretation. And what a lot of people don't understand is that CRA's interpretation is not gospel. What is gospel is the court system. But the reality is that most people aren't going to go to the courts to fight over an issue like this. So we allow our clients to make an educated decision on how aggressive or conservative they want to be on that platform. But we do make an we do make it a priority to educate them that if you were to claim business suits, there is a high probability that these would be disallowed if you are audited. So now let's get into some more things that you can claim that are very standard deductions for most of our clients. And the first is our home office expense. So the one criteria for the deduction here is that the area must be used to earn business income. Now, once upon a time, they used to say you had to have physical meetings. Obviously, post-COVID world, virtual meetings are completely understandable. And there are also a couple of different methods for how you calculate the actual deduction for your home office. So most people have obviously had an office in their home prior to setting up a business, but you weren't able to claim that if you were a full-time employee, with the exception of the COVID years where they did allow you to claim that home office calculation on your personal taxes against employment income. But now with your business, you have to decide, am I calculating the business use based on square footage, which is one option, where for our clients, we'll look at a number of things. We'll look at the office space as the numerator, but we'll also throw into the numerator the garage if you're using a vehicle for work, which most of our clients will be. And then we can use the office space plus the garage space in the numerator. For the denominator, we're going to take the whole living space, including the garage, because we've used that in the numerator. But we'll take out the common areas, which are the kitchens, the hallways, and the bathrooms. By doing that, typically the average person is going to claim about 20 to 25% of their home office expense, which could include heating costs, electricity costs, water and sewage, property tax, home insurance, landscaping, and most importantly, the actual mortgage interest or the rent. Now, we do need to be clear when it comes to the home office. You can own, if you do own the property, you can only claim the mortgage interest, not the principal, which is the most commonly misunderstood thing. So we have a worksheet that we provide all of our clients for the home office, and we do ask for the mortgage interest, and often people do confuse that with the amount that they pay every single month. And it's important to know and understand that no, it's not the amount you pay every month, it's the interest. Typically, you'll be provided a statement from your bank on an annual basis that tells you exactly how much interest that you've paid. And with many banks, you can actually go online and see that information right away. But the home office is a great deduction that, like I said, prior to incorporating, was most likely not a deductible expense. Similarly, we've got the automobile expense. Now, the criteria for the automobile expense is it must be used for business activities. And in addition, you are not allowed to claim mileage driving from your home to your work site. Now, the important differentiator that we make is that if you are claiming mileage to a client site, it's that you're driving from your home office to your client site, not from your home. And so it's important, if you want to be able to claim that mileage to go to a client site, that you do have a home office in order to claim that mileage. Now, again, uniquely with the automobile expense, you have two methods for calculating your deduction here. So much like the home office, where you have two methods to calculate the percentage of use, here you can use either the actual method, which means that you would take a percentage of your actual costs based on the amount that you drove. So let's say that you drove 10,000 kilometers in total, and 7,500 of those were for business related expense, or for business. Then 75% of your actual expenses, which would include your gasoline, your insurance, your maintenance, your CAA, all of your costs associated with your vehicle, you would take your percentage of use, which is the business driven for the kilometers driven for business, divided by the total kilometers driven. And that will give you a calculation to multiply by the actual individual expenses. Now, there is also a simplified method where you use the mileage rate. So you just keep track of the mileage that you drove for business, and there's a calculation based on the year in which that you were claiming the business expense. So there's a specified amount from CRA as far as what you can claim for mileage. Now, the thing with automobile expense is I don't want you to just include the going to the client site. Don't forget going to the store to pick up supplies. Don't forget going out to restaurants where you're having meals and entertainment. We'll discuss that in a second as far as other categories that you can claim. Um, Going to visit potential clients or partners who might be providing advice or coaching or counseling. There's a long list of things that we can include other than just driving directly to the client site. Now, if you are going to use the actual things you want to keep track of are going to be the fuel, your repairs, your license fees, your registration fees, your insurance, your maintenance, your leasing costs, or your depreciation, which we will calculate depreciation for you. We just need to know how much you paid for the vehicle and when you purchased it. So there are, again, maybe to take a bit of an aside here, I'm often asked when it comes to automobile expenses whether you should buy or lease a vehicle. And my short answer here is don't let the tax tail wag the dog. You should be deciding on lease versus purchase based on your own individual habits. Are you the type of person who wants a new car every couple of years, in which case leasing might make more sense for you? Or are you the type of person who's going to buy a car and drive it till it won't drive anymore, and maybe purchasing makes more sense for you? What I tend to personally do is I will lease and then buy out my lease, because I'm the type that will I want a new car, but I'm going to drive it till the wheels fall off. And the reason that I do that is because there are maximum amounts for what you can expense as far as lease amounts, and there is a maximum amount you can expense as far as depreciation. So for those of you unfamiliar with depreciation and how that works, is if you purchase a vehicle, you take 15% in your first year because it's considered a half year rule. And in each subsequent year, you take as a deduction 30% of the declining balance. And that's what you claim as your expense, as opposed to the lease cost, where you just claim the lease amount that you've paid up to, of course, the maximum lease amount. But what I find is that oftentimes the amount that you can claim for depreciation is relatively low, very difficult to find a nice car that is under that criteria. But if you lease first and then you buy out your lease, the buyout of your lease is a purchase. So you get to deduct the lease amounts every single month and then amortize the lease buyout at the end. I find that allows me to get a much nicer car, which is a personal preference. But again, don't let the tax tail wag the dog, because vehicles are depreciating assets. They are not investments, with the exception of maybe Jay Leno's investments in his vehicles, which might appreciate. Most of us are having vehicles as depreciating assets, which means you're better off to not spend the money and just have a cheap clunker. But some of us like to have newer cars and fancy cars so they can tow their RV, and to each their own. Now, I do see there's a couple of questions coming in here, so let me see if I can get to those. Is home office only for principal residents? What about working from the cottage? Certainly more aggressive to claim multiple home offices, but we have done it. We will allow it. Again, the question is going to come down to reasonableness. Is it reasonable and justifiable from that perspective? I'm more than happy to argue that across the table from a CRA auditor and allow them to tell us, no, you can't. So my perception is always, if it's in the gray area, I would claim the deduction and let CRA tell me we cannot claim that deduction. It's, potentially justifiable and defensible. Of course, everyone's situation is different. And you do have to have that dedicated space available for working. But yes, potentially you could claim multiple home offices. My year end, first ever, is May 31st. I have yet to pay out any mileage expenses because I don't know what rate will be better. Do I have to write myself an expense check before May 31st for taxes, or can I figure out which expense is better after my year end and still capture that as 2024, 2025 expenses? Yes, you're not required to reimburse yourself. So there are specific rules as far as the director's advance or director's or shareholders loan account. Sometimes those terms are used interchangeably. So anytime that you pay for an expense on behalf of your corporation, you're getting a credit to the director's advance or shareholder loan account, which means the company owes you that money back. Now, if you're taking money out and not claiming it as salary or dividend, then you are taking a debit balance or increasing the balance of the shareholder loan account. And the rules say that you can only have a balance in the shareholder loan, meaning that you owe money to the corporation for 1 year and then it must be repaid in the subsequent year. But there are no rules as far as when you have to repay the shareholder. So you can have a debt to the shareholder outstanding for as long as you, the shareholder, are willing to leave it there. So yeah, I would say don't worry about cutting yourself a check. Get to the end of the year, figure out what method is available to you. And again, generally speaking, what we like to see is anytime that there is a credit balance in the director's advance or a shareholder loan money from the corporation, leave that in there because that gives us control to reduce the amount of salary or dividends that we declare because we can offset that against the money that you took out so that you don't have to take that into income. Got a couple more that have come in through here. How far back can CRA go in asking for actual expense receipts? 7 years, what is most likely? So, believe it or not, after 3 years from your notice of assessment, returns are what they call statute barred, which means they can only go back to 7 years if they can prove fraud. Now, where this gets confusing is it's from the date of the notice of assessment. So it's not 3 years from your year end. It's not even 3 years from the date you filed, although that tends to be the date of notice of assessment these days. It's 3 years from the date you get the assessment. So once CRA is basically accepted and acknowledged the return, 3 years after that, the return is statute barred, which means that if you have claimed any expenses that were in the gray area beyond that 3 years, it is extremely difficult to CRA to go back beyond that 3 years because they would have to prove fraud to be able to go back beyond those 3 years. So that brings us to the end of the questions. I'm going to jump back in to our slide deck here. We covered the automobile expenses. Next, I want to cover meals and entertainment. So meals and entertainment is an often overlooked expense category for many people new to being an independent contractor or new to being incorporated. So meals and entertainment, or what we call business promotion in our chart of accounts, is the category for when you're going out for a meal with one or two other people. If it is a large group event and all your employees are invited, which you're an independent contractor is typically only yourself, we can potentially claim that under advertising expense. And the difference between advertising and business promotion is that advertising would be 100% deductible, whereas meals and entertainment is only 50% deductible. So that doesn't mean you report it to us at 50%. You give us the full amount, and there's actually an add back on your tax return because CRA acknowledges that you are getting some personal benefit out of this. And where we often have deductions that people don't realize they could claim are meals and entertainment with your spouse. Now, it doesn't mean your meals and entertainment with your spouse are deductible, but for most people I know in most situations, you and your partner are partners, and you talk about your day at work. You talk about your business. You get coaching and advice. Very few people do I know make financial decisions about their business without input from their spouse and their partner, which means when you're going out for a meal with your partner and your spouse, that's a potentially deductible um, business expense. In addition, you could be going out with potential clients or people who might refer you to other people. And oftentimes, what I find is that there's that 6 degrees of separation, and virtually everyone that we dine with has the ability to help our business earn income. And just to the extent that you share with them what you do, and you talk about your business for a portion of that meal, you can claim that as a legitimate meal and entertainment expense. Now, CRA, as I said, is going to add back 50% of it because they do recognize that you get a benefit out of that. In addition, if you are traveling and you are traveling for work, you can claim those meals even if you are not eating with another individual and discussing businesses. Now, if you're not traveling, there is a requirement that you are at least entertaining and dining with another individual. It doesn't mean that you have to be paying for that under other individual's meal, but there does need to be some entertainment and some business promotion going on there. And unfortunately, this means you can't just claim going out for lunch just because you are at a client site, unless you have traveled more than the minimum required number of kilometers, which I don't have off the top of my head, but I might get Kasim to dig that up and post that in the chat here for me, because I should know the actual kilometers, but I just can't think of it right now. But there is a certain number of kilometers in order to claim it as meals while travel. Now, once upon a time, meals while travel was 100% deductible. It is not anymore. It is still 50% deductible. So you just include that no longer under meals while travel, just under business promotion for our clients. But there's a large amount of expenses that you can claim here. And again, oh, sorry, I'm going backwards here. Let's get my slide moving in the right direction. Um, and this could include even things like sporting events and theater tickets, and all of the things. Again, the big differentiator I want to make sure to distinguish between is a event as opposed to meals and entertainment. Now, again, if you're having an event every week, that's probably going to be unreasonable. But you can think New Year's parties, celebrations, big events. And if you have a large group of people, that could be potentially claimed under advertising as opposed to business promotion. And again, you're going to get the 100% deduction versus the 50% deduction if you're able to do that. So this is advertising expense again. So we've got those entertainment that we talked about when it's a large group event. But in addition, you can have promotional gifts, advertising in Canadian media, business promotion through social media. There's a lot that could fall under advertising, including your website, which if you don't have, you absolutely should. Again, that goes back to our PSB stuff. Look like a business to be treated like a business. And again, there are a couple of criteria here. It does need to target a wide audience to increase the business exposure. And there's no necessary specific ways to limit this. But gifts here should not exceed a maximum of $100 for full deductibility when we're giving promotional gifts. Now, there are some exceptions to that, but that would be a good guideline that I would recommend using for that. So that covers our advertising. We do have a few other categories that fall under those areas where you might have general expense. And I can see some questions going on in my internal chat. I was looking for the number of kilometers, Rachel, that you have to travel in order for a meal and entertainment to be considered meals during travel. There is a set amount. I just can't remember what it is, and I'm sure one of you can look that up for me really quick. But other expense categories that you might have are your cell phone and internet, which we've discussed earlier, which you are most likely using for business. Seminars and workshops, which most people get is pretty specific to your business. But obviously, the travel expenses associated with that. And what I would strongly encourage is looking at travel in a new light now that you're incorporated and trying to maximize the deduction of your travel. Now, if you're traveling to somewhere in the Caribbean, CRA is going to assume it's personal until you prove that it's business related. And coinciding travel with a conference is a great way to legitimize a deductible business expense for travel. So going to conferences, you're going to be able to claim the airfare, no problem. You're going to be able to claim the hotel during the days of the conference. If you stay a few extra days, maybe you don't claim those last 2 days of the hotel, but you've got 90% of the travel as a deductible business expense. And, more and more, a lot of these conferences have flexible schedules so that you can enjoy the city as well as get some great education while you're out there. Other ways that you can legitimately deduct business expenses for travel include looking at real estate investment or going to look at other business opportunities. The key there is going to be documentation, 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 because it's going to be assumed personal until you prove that it's a business related expense. So if you're traveling to look at potential real estate investment opportunities for your business, make sure that you've got the name of the real estate agent, that you've got a calendar of all the viewings that you went to do, and just document that as much as possible. You may never, ever be asked for it, but it's better to have the information and not need it than need the information and not ask for it. And that pretty much is the list of the most common categories when it comes to the blend between personal and business expenses. Of course, I do want to open it up for any questions that you might have. I do see one coming in already. Let me take a look at this. In the earlier days, CPA 4IT, incorrectly written as CA 4IT, which CAs don't exist anymore, would look at cred expenses submitted and compare to previous years, e.g. books last 5 years at 2,000 per year. Suddenly this year, 10,000 for books expenses. Does CPA 4IT still look at this? Yes, we do a benchmark. You were provided a benchmark. Every client is provided a benchmarking analysis to show you how you compare to the average and the median. We also, as accountants, it's one of the first things that we're looking at because that's going to be one of those big red flags when we see substantial movement in one category. So we are always looking at not only how you compare to your own history, but also against the benchmark that we use. Now, because you're above average or you're above previous years doesn't mean you're not entitled to those deductions. It just might mean that you're going to get some increased scrutiny. So we better dot our I's and cross our T's to make sure that we can stand up to that increased scrutiny and or maybe be a little bit more conservative on some of those categories. But yeah, we absolutely run a benchmarking analysis. You should be provided, you will get a copy once with a copy of your draft financials, and then again, a updated version with the final version of your financial statements. So yeah, you'll get that benchmark analysis. And yes, we as accountants are looking at and comparing the information against the previous years for your individual firm as well. That, believe it or not, looks like it's the end of our questions. Oh, wait, no, it's not. Rachel just getting back to me. Well, the CRA does not set a specific number of clubs for claiming meal expenses. Eligibility generally depends on being away from your regular place of work for a significant period, typically 12 hours or more, and in some cases being a certain distance away, such as 16 kilometers. There is a specific mileage. I will get back to you on that. I know that there is a specific mileage. I just don't know what the mileage number is off the top of your head. I'm going to come back and post that in the comments on LinkedIn because I'm pretty sure that there is It's 60 kilometers. There we go. Oh, that's for long haul truck drivers. Um, yeah. Thank you, Rachel. Much appreciated. For those of you who aren't clients, we are here to help. We do offer a free initial consultation. We do also offer in-house paralegal, which means we can do incorporations, we can do dissolutions, and of course, as mentioned earlier, we do have a couple of proprietary tools like our benchmarking analysis, our audit representation protection, and our industry expertise. So if you have any other questions, please reach out and connect with our team. We'd be more than happy to help. And again, thank you to everyone who joined us on their lunch hour break. This was a short one, but a good one. And glad you found it useful, Joe. And if anyone has any other questions, I'll leave it open for about another minute or so. Otherwise, I will wrap up here. Thank you, everybody.